Yo, what's up everyone? Welcome to the Trading Journal. Today we're going to again review some of the charts that I'm looking at and go from there. So let's just dive right in. Okay, first one we're looking at, let's move this camera over here. Okay, first one is the Qs. So we put on a trade on the Qs on the basis of seasonal strength that the tech sector exhibits normally in the last quarter of the year, and a little bit of a spillover into January. So we'll see how it goes. Okay, so this particular chart is my return on risk zones I've marked, and also it's just a simple daily chart that we use to track the 10-day moving average along with the MACD up here. Alright, so again, nothing really has changed here. The MACD histogram is retracing. You can see upwards this way, and price has consolidated and done a bit of a breakout. Today, January 6th, was a pretty big day. We got up move of 2.76%. So we'll see if this holds and gets up to our profit levels here, and we may be looking to get out at 1R, 2R, who knows. Maybe a little bit of greed will kick in, and I'll ride this trade and scale in. So still working on how to effectively scale into a position without losing too much of your gains. Okay, and volume, we do see an uptick in volume as well over the last 3 to 5 trading days, which bodes well for the move in the Qs. Alright, next chart. This is again the same chart, NDX, but with a different look. It's using high-low bars, and we see right over here a nice strong move above the 10-day exponential moving average. And even my slow MACD, I call it the slow MACD because I'm using double the periods of your standard 12, 26, and 9. So you double that up. It's a little bit of a slowing moving indicator that I just edited myself. Okay, so not much to see here. This is the weekly. We looked at this in our last Trading Journal video as well. And one good thing, positive development, is the MACD histogram for this week is positive. Not as high, not a significant move, but it is positive. And look what we see here down below. So with that histogram move in mind, with prices holding at this level is right around 10,684, is constructive for the market. So we'll see how this turns out. Okay, next chart we're going to look at is the S&P 500 with the Elder impulse system. So basically it just colors the high-low bar candlesticks red, blue, or green, and it corresponds with the moves in the histogram. So here we see a green candle with a still slightly negative histogram. I'm not too sure what that means, but I think we're on the cusp of a breakout here. We'll need to watch, and price is going to tell us that. So that's a good sign to see that green. It's like go. Okay, here's another chart that I've marked up. It's basically just trend lines, no moving averages, no volume, nothing, just price trends. Let's make this one smaller. Actually, it's a bit big. If you can hear that, that's Nas' new album. It's really dope. Okay, so a major area of support we're having is 3,500. It's a huge support. You can see price reacted significantly right around this level here, and a short-term area of support would be the 3,900 level. Okay, we're back. Hopefully this picked up where we left off. But again, back, we have long-term support at 3,500, short-term support at 3,900, and it looks like right now the market is just trying to get right, if you can see this, right above the 3,900 level. It's a short-term important level that we want to watch. And then obviously we want to break out above this trend line here. And then I think we're off to the races until April. We'll see. Why do I say April? April's based on the trading almanac that tells us there's strength from November to April. We'll see if that holds true. Okay, so those are the S&P and the NASDAQ. Now we're going to move on to the, it's called the geometric index. It's basically the median stock. So think of it like if you were to put all the stocks in the universe together, this is the chart that you would see. Okay, and so I like to use this as a signal for breadth. Okay, and again, what do we see? Lo and behold, right below an end of December till now, we're seeing a breakout, and today's candle is pretty nice, and we're seeing a positive divergence in the MACD histogram as well. It's gone positive. This is the most positive I've seen out of other indices. While we're on that topic, let's check in and see how the Dow looks. Okay, and so the Dow hasn't turned positive yet either, but it's likely next week. We'll see. All right, so the next chart that we're looking at is the VIX. So this is a little bit different from last week's. With the VIX, what we want to look at is volatility, and it's a bit of a gauge on sentiment. So today was a big down day in volatility and corresponds with an up day in prices. If I have a chart right, okay, let's make this smaller so you can see a bit of an inverse relationship between the VIX and S&P. Doesn't always hold constant, but in certain times it does, like now. So let's see if this gets a bit smaller. Okay, here we are, point in case right here from October, the VIX starts to fall down, and price, which is below here, the S&P 500, it rises. So there's the inverse relationship. Today as well, the VIX is down, and you're seeing the S&P up. So let's see if volatility continues to deteriorate and whether that corresponds to higher prices in the S&P. I think I have a longer term look as well. And here's a 30-year look. What we see, what stands out to me the most is from basically 2018 till now, there's been a general uptrend in volatility. And we do see major moves, spikes in price as well. So it kind of makes sense. Okay, next one. Similar to the VIX, where we know whether there's a risk on or risk off type of sentiment, we can look at consumer discretionary and consumer staples to see the relationship. The idea behind this relationship, the discretionaries and the staples, is if there is optimism on the economy and spending, then discretionary stocks should do better. If there is going to be less spending on discretionaries and more on your staples, those goods that we can't do without, so to speak. If that's the sort of outlook, then the staples will outperform. So what do we see from basically 2022 till now? The staples sector is significantly outperforming the discretionary sector. So there isn't too much optimism in the spending habits of consumers right now, based on market participants. Looking down here, we see a slight move up I wouldn't consider this much meaningful. It's only 1 week worth of data, so there isn't a risk-on mood in the markets just yet. I think we're really, really early on with our per hour trades, and the market, again, is still early on in its decision. Okay, another unique chart that we have is gold. Gold is rallying lately, and we can take a look at the relationship right now. So this purple line is the price of gold. It's above its 26-month moving average. It's a bullish sign. You can go back and see any other period where it crossed above, led to a good time. So here's one in 2016, a breakout, and here in the year 2000 there's a breakout. There's one over here in 1993, but gold ended up just moving sideways. We'll see what happens here, but yeah, so that's the relationship with gold. And down here, this is a relationship of gold and the S&P 500. So is gold doing better than the broader stock market? The long-term trend says no. However, in the short run, as you can see up here, it has just broken positive. We'll see how much of this holds true. From the year 2000 to 2010, it was gold was doing better than the stock market. But then from basically the early 80s all the way to the year 2000, for 20 years, gold underperformed the S&P 500. See what happens from here. Okay, next chart. Again, risk on, risk off. So we're doing an intermarket analysis here with the NASDAQ versus the S&P 500. The NASDAQ has more riskier names, smaller companies, versus the S&P 500. And the tech sector has been steadily underperforming the S&P 500, although lately, over the last few weeks, we're seeing some consolidation. We'll see how that turns out. We'll wait for time. We've got 2 more minutes to go, and should be enough time to review our last chart, which is on breadth. This is on the NASDAQ, tracking what percent of stocks are above its 200-day moving average. Okay, the thing that stands out to me is the 10-month moving average has ticked up. And in the past, once it ticks up, it doesn't really tick right back down or start moving down, which would indicate to me that there is some strength coming in. There are some buyers starting to come back in to the beaten up tech sector. Price still hasn't made it above its 10-month moving average. The 10-month moving average is probably the safest, one of the safer moving averages to use to base your next trade. Okay, so that is basically a review of some of the charts that I looked at today. There's many, many more. You can see this whole list, and eventually over time I'll share them with you. Okay, and that's all she wrote for today. Hope you guys had a good trading week.